Hi, this is Pete Andresen, and it's Juneteenth. It's the celebration of Juneteenth anyway. It's June 20th, 2022. And I just wanted to share with you a little bit about what's going on in the financial markets. The question I got last week was punctuated by the Federal Reserve raising the interest rate 0.75%, which was historic, and one of the worst weeks since the year 2020. That's only 2 years ago, but still people are reacting pretty strongly. And one question I'm getting right now is, how long is this going to go on? How long is a bear market going to last? So let's discuss that a little bit. Disclaimer and lawyer speak, traditional. This video is information for my clients. If you're not my client, I'm not your investment advisor. Nobody has a crystal ball. These are my perceptions. Investments can go way, way down. We're using history, but history is an uncertain thing. And perfection is, as far as I know, impossible. Let's take a look right now. As of June 17th, the last time the stock markets were open, the Vanguard S&P 500 stock market index fund is down negative 22.35%. Okay, so we're in a bear market. That's not even close to what we've experienced in the past, not even in the recent past. But what makes this year different, what really makes this year different, the NASDAQ stock market, the QQQ, that's an ETF, is down 30.87. We don't own it. We do own some other investments in technology, but it's been a rougher time this year in tech so far. The big difference is that the bond market is getting pounded. We don't own the very aggressive bond funds that are suffering the worst, but we are getting hurt. There's no question. The Vanguard long-term treasury fund is down negative 22.67%. Think about it. When was the last time the bond market was down more than the stock market? The answer is back in the 1970s. So that's something different. You have to go back in history for that one. And cash has about an 8% negative rate of return after inflation. So that makes it the forebears, I guess you could say. Real estate hasn't started to budge yet. I wouldn't be surprised if we have a down market there too. I can't guess what's going to happen there. Could be little, could be a lot. But anyway, this is the third time in 72 years that we've seen all these markets down at the same time. So we have to go back a long time in history to figure this out. And yet, historically, it's happened before. We have been here before. However, the bond market declines are especially painful for me because they remove part of the diversification benefits that we're used to having. You have to admit, Andresen and Associates has had great results by shifting into the bond market, and we've ended up with positive experiences in bonds while the stock market dropped. That's not happening now because of this rather rare situation where the interest rates are going up and thus bonds are going down. So I do believe that the Federal Reserve is correct in raising rates. We shouldn't have gotten here in the first place. They went way too far on stimulating the economy. However, we have to be here. So it's painful but necessary. Now, how long will the declines last? Cut to the chase. After suffering 10 separate bear markets between 1950 and 2021. This is for 2021, so that would make us, now we're in number 11. The S&P 500 recovered and eventually achieved a new all-time closing high each time. So bear markets go down and then they go up and they recover and you go on to higher highs. It's not the end of the world, at least historically. Basically 25.5 months or a little more than 2 years. The quickest recovery was in 3 months in 1982. And the longest recovery, and by the way, that 3-month recovery is why we aren't selling out, because those recoveries come without warning and bam, all of a sudden you're at a new all-time high. The longest recovery took 70 months or nearly 6 years. And if you went through the first decade of the 21st century, it was grueling as well. So markets can stay down a long time. Good thing we're diversified, because this does not include international, small stocks, value stocks. There's a lot of ways to play this. We're not just in the S&P 500. How far should we expect the stock market to fall? And the short answer is we don't know. It depends. As you can see on this graph, the average decline of about 20% for half of those, and then you get into the longer, bigger, more nasty declines. So really, if you're looking at 35%, 40%, you're pretty much covering the historical average. The worst, of course, was 2007, where it fell to pretty much 60%, which is brutal. And that's, of course, our big fear. There's a lot of reasons why I don't think that will happen this time. Again, this is from Ben Carlson's A Wealth of Common Sense. If you look at it, the average, well, if you look at the declines, they average about 30%, something like that, 40%. And the average time is about 2 years, a little more. Let's be a little bit pessimistic here and say it'll take 3 years. Now, this does not include what happens if you're buying while you're down. That transforms the entire experience. Here are my basic expectations. High inflation is intolerable politically. We've talked about that. Central banks will raise interest rates until inflation declines to 2% or so. If they take a long time to do that, we're going to have stagflation. It's going to be ugly. They're not idiots. They know that. So I'm expecting harsher interest rate raises in a shorter period of time. Stock markets will decline as long as that goes on. As long as interest rates continue to rise, stock markets will decline. Rising interest rates and inflation may cause a recession. It's looking like that. And frankly, that's normal if that happens. If we have a recession, inflation will moderate dramatically. Gluts and deflation may be an issue in a recession. Interest rates will decline and the bond markets will thus recover. This is why we're not selling out of bonds, because interest rates cannot rise infinitely to 30%. The economy will collapse before that happens, but realistically, we're just going to have a recession instead of a collapse. Isn't that better? Stock markets will recover when that recession is underway. And here's the thing, they will recover without telling you in advance. People who say, I'm going to wait till things calm down. It's not calm when the bottom is hit. You won't know except in hindsight. And that's why we don't sell out. And that's why we're going to be buying, even though the markets will be declining. It's going to be an ugly, unpleasant process. But since we know that, we just gut through it. The average time for that is 2 or 3 years. We're 6 months into it. Events may irrationally change this timeline. We're talking about Ukraine, political unrest, whatever. But basically, let's plan on 2 or 3 years. Now, building long-term success in investing requires courage. The media is not our friend. The media is going to be rattling on about all kinds of stuff. We have to ignore the media, press onwards. We started this out in a relatively low-risk position. Yes, we have taken losses. Yes, you will see declines in your portfolio. We want to press on and invest carefully, because we are likely, historically anyway, can't speak to the future, we're likely to create lasting value within 5 years or longer if we can invest now. But we don't want to rush, because history tells us we're probably looking at 2 or 3 years. Thank you deeply. Happy Juneteenth. Blessings.